All right. Hi, everyone. We are live. Thank you so much for joining another week of Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined by CNBC senior markets correspondent Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hi, Katie. How you doing?
Doing well. I know it's been another busy week for you, Bob.
Yeah, it's tech stocks are getting re-rated. I think we should probably mention that somewhere.
For sure.
And the Fed caused an awful lot of confusion. And I'm one of the people that's on the air at 2 o'clock when the Fed meeting comes out, and they turn to me and say, "So what's the market saying?" And the Fed issued a statement that clearly had some dovish lines in it that made investors think not necessarily they were going to stop hiking rates, but that they were cognizant of the fact that that rate hikes might have an effect on the economy and slow it down. So what they're looking for is some sign that the Fed was aware of that, not stopping raising, just aware of it. And they added a sentence that indicated they were. And so the market took that very positively. And then coming in to the actual press conference, Powell essentially tried to almost walk the whole thing back and say, basically we're thinking rates are going to be higher for longer, and we are he said don't believe there's going to be any pause. The market doesn't believe there's going to be an immediate pause, but they were hoping for recognition of the effects of raising rates, and that they would acknowledge that. And he basically brushed that off. So it caused tremendous confusion in the market. Mm-hmm. And there was a big swing from the high to the low in the day.
Right.
And people don't really appreciate that, to be honest with you. They'd like a consistent message. Bullish or bearish, at least be consistent. And the Fed, and they weren't.
Right. Yeah, it was definitely interesting to see the market reaction after that. So let's start with the Fed. Like you said, we got another 75 basis point rate hike this week. So what does the Fed's rate hike mean for investors?
Just in simple terms, raising interest rates raises the cost of everybody doing anything. The Fed only controls short-term rates, but don't kid yourself. The short-term rates feed into intermediate and long-term rates. So, if you think it's a coincidence that mortgage rates have gone from 3% to 7%, as the Fed has been aggressively hiking rates, you're kidding yourself. That's why. And so mortgage rates are a simple way to indicate that the Fed is having an impact. The good news is savers are doing a lot better. I've gotten interest from people who want to know how to buy 2-year Treasury auctions, because you're dealing with 4.5% right now. I never had that issue for the last decade. We haven't had anything like that. So savers are getting some more money. My mother called and said the CD rates were going up. They're still pretty paltry, but that's a sign that the Fed's having an impact. A modest amount of inflation is not necessarily bad. There's a reason this 2% target is there for the Fed. That's just enough to kind of keep going up and slowly devalue the value of loans that are out there, but not too much to have a deleterious effect on everybody's life. But when you start getting into 5, 6, 7%, well, that feeds into demands for wage hikes that can be very long term. By long term, meaning embedded, meaning every year people start expecting 7, 8, 9% wage hikes. And that's how inflation gets embedded. And they want to stop that cycle. That's why they're just being so aggressive, which is understandable. But you can see what's happening here. The housing market has already slowed down, for example.
So, Bob, big cap tech stocks like Apple, Microsoft, Amazon, Alphabet, they've all been hit hard this week. So what is going on there? Can you explain that for us?
Yeah, I mentioned this in my Trader Talk today. And by the way, I have a Trader Talk most mornings. And you can go on tradertalk.cnbc.com and see it. Usually gets put up just before the open, somewhere around 5 o'clock. But what's really happened, if you want it in a simple term, analysts and investors are re-rating the earnings growth for big cap tech stocks for 2023. What does that mean? Markets move on a combination of, one, stocks and markets on one, what an expected dividend is. Number two, the trend in earnings growth, not just of the overall market, but of stocks in general. So if the trend in earnings is, if you're expecting a company to earn 6% earnings, 6% in earnings growth a year, and all of a sudden you come to believe that it's going to be 10%, that's a notable change in the earnings growth. That would probably argue for a higher stock price. The other is the multiple. The multiple is how much are you willing to pay for that earnings? So if you have $10 a stock and you make you're estimating you're going to have $1 in earnings, the multiple is 10 divided by $1. But there are circumstances where you might say, okay, they might still be making $1. Their earnings are not going to change. They're not going up or down. They're staying stable. But due to the circumstances, I'm not willing to pay $10 for that. Under what circumstances might you not want? Well, I don't know, 4% on a 2-year, that competes. Maybe I'd be more interested in buying a 2-year than buying that stock. That's a sure bet, 4%. Maybe I'm not sure about, say, 6% return on earnings for that company. So under that circumstances, maybe I'd only be willing to pay, pick a number, instead of $10, $8 or $6. You see, stocks compete with bonds for returns. You have a risk-free rate of return of 4% on a 2-year. That's pretty good. You want to take a risk and maybe buy Microsoft? Yeah. Now, in the last 12 years, you're going to do a heck of a lot better than 4.5% a year on Microsoft, but maybe not so much going forward. Maybe the risk is higher than you think. So what's happened is the earnings growth estimates for these companies have come down a little bit, in some cases rather dramatically. In the case of Amazon, for example, which is not technically a tech stock, but let's put it this way, it's considered a tech stock. So when that happens, there are companies out there that have very high multiples, for example, where people suddenly aren't willing to pay these high multiples anymore for them, because even if they're profitable, the growth estimates are going to come down a little bit, or there's competition with other places for the money. So in a nutshell, that's really what's going on. And there are people out there who say it's about time. Why should 25 or 30% of the S&P 500 be technology, essentially? That's a lot. That's a heavy weighting. Maybe other sectors deserve it, like energy or industrials. Energy was 3% of the S&P. That's kind of comically small. Now it's 5% because energy stocks have done better this year. There are a lot of people who think that's a good thing. So I don't know. I know everybody's fascinated with Microsoft every day, and we talk about it, and Apple, but maybe there are other stocks that deserve more attention. And analysts and strategists are now reweighting the earnings estimates of these. And, maybe instead of, 25 or 30% of the S&P essentially in tech, you're going to have 20% or 25%. Maybe that's a good thing going forward. Let's focus on that. Now, maybe that'll change too, but this has been a rough week. Everyone stocks are down 10% this week. Everything's at a new low. Apple's not, but Microsoft, Amazon, Alphabet, they're essentially at 52-week lows.
So, Bob, we've been getting a lot of questions about potential recession. So this question this week is, how would a recession impact the housing market? And would it be different or similar to 2008?
Well, it's not the same as 2008 quite, because in 2008, there were different causes. So in 2008, for example, we had these things, mortgage-backed securities, that kind of blew up. They mispriced the risk around mortgage-backed securities. And I don't want to go into that whole history, but the causes of this housing downturn are different, because here we had one that was due to dramatic housing inflation initially, and now some deflation. All of this is due to the Fed, partly due to the Fed dramatically expanding the money supply. In terms of housing, prices are coming down, and it depends on how you measure this. The Case-Shiller puts out a 20-home composite index, and that's been coming down for months. But we had dramatic increases in house prices in 2020 and 2021, so it should come down. And think about what these prices mean when the mortgage rates change. So I'll give you an example. A $500,000 mortgage at 4% for 30 years is about somewhere around $2,400 a month, okay, at 4%. But if you take a $500,000 mortgage and make it 7%, it's like $3,300. That's a lot. $2,400. It was 8 months ago for $500,000, and now it's $3,300 a month for $500,000. That's the difference between 4% and 7% more. That's a lot. And so people are looking at this and saying, you know what? Okay, so I got this $500,000, mortgage. So I don't want to pay that. I want to be able to pay that $2,400. So I'm going to bid down the price of the house. That's what happens. People don't necessarily look at the price of a house. They look at what they're paying on a monthly basis, and they say, wait a minute, I'm paying $3,300. My budget was $2,500, but I still want the house. Okay, I'm going to bid lower on the house. And that's what's happening. The minute the mortgage rates started going up, you start seeing home prices soften a little bit. And maybe that's a good thing. Not great if you're a seller, but, home prices, as a percentage of people's incomes in the last 2 years have definitely been going up. So I'm in favor of modest increase in home prices over time. A home is a separate asset. I look at the world as sort of different buckets of assets, and the average person should have private retirement, like a 401k or a pension invested in stocks and bonds. They should own their own home. And eventually, when they get older, over 62, they should have Social Security at some point. So there are three buckets here. There's personal savings, 401k and maybe a pension. There is a house, which is an investment. And then there's a Social Security, which is actually an annuity. If you think about it, it's adjusted for inflation. And you have these three buckets. And I'm in favor of slow increases in home prices. But home prices, they shouldn't go up 20% a year. That's a little weird to see that. And that's what we've been seeing recently. So more stability in home prices, I'd be in favor of.
Bob, didn't you start out as the real estate correspondent at CNBC?
Yeah, I was a long time ago. My father and I, the first book I ever wrote was called How to Be a Successful Developer. We taught a course. My father and I were adjunct professors at the Wharton School in Penn, and we taught a course in the mid-'80s on real estate. We turned into a book in 1989 that John Wiley published, and I got the job at CNBC when it first went on the air in the summer of 1990, actually, the year after it went on the air, as the real estate correspondent, and I switched to stocks correspondent in 1997. That's when I went down to the New York Stock Exchange. Mm-hmm. So I've had years at CNBC. I was initially the real estate correspondent, and I've been the stocks correspondent for 25 years.
Yeah, well, it's definitely interesting to hear your perspective on that then. So thanks, Bob. So another topic that is on people's minds right now is next week's midterm elections. So what do the midterms mean for investors in the market?
Well, there is a certain perceived wisdom now that the Republicans are going to win control of the House of Representatives, and it's a toss-up about whether they win control of the Senate. To the extent the market, there's an old chestnut, market likes gridlock, because there's an old joke, nobody's safe when Congress is in session because they could do anything. So there may be some truth to that. Market may indeed like some gridlock at this point. There's also historic trends that happen here. So generally, this is not always true, but generally the markets tend to underperform in the year leading up to the midterm elections and tend to outperform in the year after. This is not always the case, but this has been pretty widely studied. And in general, the S&P 500 is flat to just slightly up in the year before, leading up to the election, this right now, and tends to be much stronger in the year after. Why this is true is debated, but that's pretty widely believed. So in addition, for the bulls, in addition to the seasonality factor, there's this thing called the best 6 months where the market tends to do really well November through April, better than the 6-month period from May to October. So you get seasonality with the best 6 months. It tends to rise towards the end of the year. And in this particular time period we're in now, period after the midterms, it tends to be stronger. So you can see why the bulls are really hopeful that what is broadly called seasonality factors will help lift the market. None of this is going to matter if the economy goes into a recession. I can assure you it's not going to save anybody. If we definitely go into a recession, we're going to have another lower leg down in the market, probably. So don't kid yourself. It's not a, but there is definitely a seasonality pattern associated with the midterm elections.
So Bob, next question is kind of about your portfolio, not your portfolio, but portfolios in general. So our listener was asking, what is your advice on diversifying a portfolio geographically? Well,
this is an interesting question because up till about 3 years ago, I would have said to you, I think that it's portfolio diversification is one of the key aspects of successful stock market investing, and diversifying across asset classes and diversifying geographically. What does that mean? Well, it means you own something of, large cap stocks, small cap stocks, and international stocks as well. This has become a lot easier thanks to exchange traded funds where you can buy the entire global market or slices of it any way you want. And this is what I do, by the way. In my new book, I talk about what I own and show you how I've come to owning these. But by and large, simply put, my single largest holding is the S&P 500 fund. And then I own a small cap fund and I own an international fund. Now you can slice and dice international funds a lot of different ways. But a very typical way would be to own a fund that owns stocks in proportion to the country market capitalization. So for example, if Japan is, the United States is 55% of the world's stock market equity, you'd own a fund that had 55%. And if Japan is 15%, it would own 15%, and China was 10%, be 10%. So investing by market capitalization globally has been very popular for a long time, and you can do this with ETFs. Someday maybe we can talk about different symbols that you can look at. I generally believe in that. There's a little bit of a problem with this because markets don't behave the same way, and this is one of the reasons you diversify. So for example, emerging markets behave differently than developed markets and have different cycles. Emerging markets are very sensitive to higher interest rates like we have now. They've been underperforming. Companies tend to reduce investment in emerging markets during periods of higher interest rates. So you're not going to get the same return if you invest in an emerging market fund. If you buy into Kenya or even larger emerging markets and Indonesia, for example. So it's a different kind of investment philosophy, and you have to be comfortable with that. The simple way to handle it is just buy broadly diversified funds. There is a slightly different debate going on around ideology in China, for example. And there has been a very healthy debate in the last few years, and I think this is a good thing for people who are saying, we are trying to simply look at countries by market capitalization, and this may be fine if everybody is, vaguely market-oriented or capitalist, but what happens when you have a country like China that really is not, that's totally largely state capital oriented, and do we necessarily share the same values, or should we be investing in something like that? So there are people who are just market neutral. They'll say, look, I don't care. I can buy the stock. And there are value investors who say, I don't care either. When China gets cheap below, pick a number, 14 times forward earnings, I'm going to buy it. And I'm not ideological. And there are other people who want to debate that. And I think that's a very healthy debate. I mean, I'm a capitalist. I believe in market principles, but I also believe in democracy. And I tend to be less state-oriented and more private-oriented. And I think this is the reason that the United States has outperformed other countries, generally, not always, but generally outperformed, because the form of private market capitalism that is practiced in the United States is a ruthlessly efficient allocator of capital. more so than even more state-oriented, state capitalism-oriented countries, even more efficient than Europe, for example. So I happen to like that, and I happen to believe in that. But with a country like China, there may be a good reason to start asking those kinds of questions. And so I'm not giving you a clear answer. I'm going to tell you there's very good, broadly diversified funds if you want out there. And then there's other ones like the Freedom Fund. Perth Toll is a very good friend of mine. They invest based on how much freedom there are in countries. And that may not necessarily get you an outperformance, but for certain people, yeah, philosophies and ideology do matter.
Thanks, Bob. So our next question, which we get a lot of questions about crypto. So can you kind of share your thoughts on crypto?
Well, this is very complicated. First off, you get the crazies who want to scream about Bitcoin all the time, and they hate anyone who says anything negative about Bitcoin. So here's my position on this. I am a big bull on blockchain. I am a big bull on anything related to decentralized finance and smart contracts, because I think it's potentially extremely disruptive. And you want to invest in disruptive technology because it makes things more efficient. You can transfer potentially real estate. You can transfer money. You can settle stocks on blockchain. You can do all sorts of things. So I am a bull on blockchain and decentralized finance. Bitcoin, I am, let's just say, neutral on Bitcoin. People ask me about what I think of Bitcoin at $17,000. I have no opinion on this. I don't, because I have no particular way to value Bitcoin. It doesn't have any intrinsic value at all. It's only worth what somebody will pay you for it. And it's just a cryptocurrency created to run off the blockchain. It was created for a use purpose because they didn't trust banks and governments. Well, I have a little more trust in them, and I'm not so worried about that. I'd rather have full faith and credit in the United States government than full faith and credit in the owners of Bitcoin, which I think has demonstrated a lot of problems in the past. So I'm neutral on Bitcoin. Just on investing in crypto, just ask yourself a couple of questions. A logical thing to do would be to say, what does this do for my portfolio? I know, let's stop kidding ourselves. A lot of people are just involved in get-rich-quick schemes around this. They've never thought it through. They're not crypto anarchists. They're not anybody. People want to make a lot of money fast. Okay? I don't think there's enough acknowledgement of that fact around here. I'd like to acknowledge that. And by the way, there's nothing wrong with let's try to get rich quick. God bless you. The chances that you'll do it are pretty small, but God bless you if you want to do it and you want to try it out. For those of us who are a little more thoughtful about this, I would ask, what does it do for your portfolio? So the two things, this goes back to modern portfolio theory, is number one, what does it do for volatility in your portfolio? And what does it do for the return in your portfolio? One of the key things about a new asset class, if you want to add it, whether it's stocks or bonds or commodities or real estate, is does it help the volatility? Because you generally want to lower volatility, not increase volatility. On crypto, I don't think crypto helps reduce volatility in your portfolio. I would say it, judging by what it's been doing in the last few years, it dramatically increases volatility. If you like that, fine, but I don't think a lot of people should aspire to that. The other thing is returns. Will this somehow provide a real diversifier of returns and help returns? I would say that the evidence of that so far is very uncertain. I do not see any long-term trends, unlike, for example, the S&P 500, where there are clear decades-long trends. 3 out of 4 years, the S&P 500 goes up. Yes, we're having a bad year, but this is very unusual. You are a fool if you don't notice the stock market goes up long-term, even if there are down years. So the problem I have with just crypto, like a Bitcoin, is I don't see it tamping down volatility, and I don't necessarily see it improving returns on a consistent basis. That makes me very skeptical about it. Okay, I hope I've been nuanced enough here. Being very clear, big backer of blockchain, big backer of decentralized finance, big backer of the whole concept behind decentralized finance, smart contracts in general. Bitcoin as a cryptocurrency running off the blockchain, I'm neutral.
Yeah, that makes a lot of sense. Thanks, Bob. So you recently wrote a story for CNBC.com called Thinking About Writing a Book You Might Want to Reconsider. So can you tell us a little bit about your experience writing your book that just came out?
The most fun I had this week was writing this article. And I have this blog called Trader Talk. It's one of the oldest blogs at CNBC. It's been around since 2007. And you can get it, tradertalk.cnbc.com. And it's my thoughts on the market. But this week I just had fun. And I wrote this book that's been out 2 or 3 weeks now. It's called Shut Up and Keep Talking, Lessons on Life and Investing from the Floor of the New York Stock Exchange. You can go on Amazon and buy it. Please do. Shameless plug. And I had a wonderful time writing this book. It took 2 years of my life. And it's a summary of what I learned being down on the floor of the stock exchange for 25 years with a lot of kind of amusing celebrity stories. People love celebrity stories, 15 minutes with Barry Manilow or 10 minutes Robert Downey Jr. or Aretha Franklin or name somebody like that. And so there's a bunch of stories in there, but mostly it's about what I've learned about investing, what I think works and does not work in investing. One of the things that you had to do, that I do as a reporter, was sort of get more involved in the publishing business and watch it a little bit. I don't know if any of you have written any books, but the title of the piece was Thinking of Writing a Book You Might Want to Reconsider. The book publishing business makes no economic sense at all. It's a stupid business. People have, just like getting rich in stocks, people have these nonsensical ideas about writing a big book and getting famous and making a fortune, none of which actually happens to anybody. Well, let's put it this way. It's so small that it's not worth really considering. So I went through the process of what really goes on in these books. And there's been an actual case where we've had real data spilled. So Penguin Random House is trying to buy Simon & Schuster. These are two big companies. Put together, they would be responsible for 50% of the books in the United States. The Justice Department is trying to block this merger, and there's been a whole trial. And in the course of the trial, Penguin and Random House have had to reveal details of what their sales are like in more detail than we've had before. And the numbers are terrible. They're comically bad. I'll give you just 2 or 3. Only 35% of the books at Random House actually make any money. Now, that's actually a very large number. You'd be, my first guess would be, I'm surprised it's that large. But the percentage that make any money at all is only 35%. But the profits are tiny in all that group. Most of these books don't make any money at all. So here's another an interesting statistic. Remember I said 35%, only 35% make money. 4% of the books sold, book titles sold, make 60% of the profits. 4% make 60% of the profits. That tells you right there that most everybody is doing terrible. 90s, most of the money is made by 4% of the books titles that are out there. The rest of the people don't make any money at all. So you have this notion in your head that you're going to make a lot of money. So then I talk about what authors are making. I'm talking about authors, full-time authors. And the Authors Guild, and I'm a member of the Authors Guild, it's basically an association of authors. And they did a study in 2018 where they found that they surveyed, thousands of their members. And they found that the average author makes $6,000 a year from their book sales. Now, the average author also supplements their income because they go on lectures or they write reviews and things like that. So they make more than $6,000. But from book sales, that's what the average author makes, the median makes. Think about that, $6,000 a year. And these are people who consider themselves, professional writers, professional authors. So I can tell you that given that it took me 2 years of my life doing this, without revealing numbers to you, if you're doing this strictly on a monetary basis, you're better off working at McDonald's. You really are. You actually are. So obviously people are not writing books for money. And nobody gets famous from it, generally, okay? So number one, the sales are going to be pretty small. Only a few percentage of books sell over 5,000 copies. 5,000, okay? Only a few percent sell more than that. So you're going to not make money or anything appreciable, number one, and you're not going to get famous. So what are you doing it for? Well, most people, and this was what I said in the article, most people end up writing books for the reason that I did, and that is because you have a really intense desire to say something. You have to want to say something, and you have to really want it. I mean, really want it so strongly that you feel like it's coming out of your skin. In my case, I've been doing something for 25 years, reporting on the markets, and I feel like I've learned something and can impart this to people and tell them. And it's very unusual to have a career like mine for 25 years. People don't usually stay around that long in anything. So you become what I call inch wide and mile deep. You get a lot, very well known in a little area of the world. In my case, it's the stock market. And I felt very strongly that I wanted to say something about what I've learned. But that was the motivation. And believe it or not, that's all you really can go on. You can't go on the idea you're going to make any money. I just told you, you're not. You can't go on the idea you're famous. I'm not more famous. I'm reasonably well known, but this book didn't make me more famous. It increased my prestige level a little. I got invitation to speak at conferences and things like that. That's nice, but the motivation has to be you really want to say something. If you're writing fiction, God bless you. I mean, you really want to have to tell that story because the chances you're going to get famous, I don't care, you're going to spot that tiny fraction of 1% that actually gets a little, don't count on it. It really is silly. It's got to come from you internal. And that's what I encourage people. That's why I still think writing books is worthwhile. I made fun of the whole thing. I said, forget it. It's a joke, but it's still worthwhile because that desire, that motivation inside you, that's worth something.
Well, I know that our audience here, Bob, is definitely very supportive of you and your new book. I read the comments in all of our Market Matters streams, and people are very excited about your new book. So congratulations.
I hope everyone will go out and buy a copy. I'd love to hear what people say. If you know, we talk a lot about what you own. There's an entire chapter, and I do something nobody does. I tell everyone what I own. Not only do I say what I own, I show people how I got there, the whole journey, 30 years, and some of the stupid things that I did. Owning bad investments initially and having overconfidence in like my own company stock. I described my disastrous relationship with General Electric stock. Disastrous. I did things that I knew were stupid. Knew they were stupid. I didn't do them and then 20 years later said, oh, gee, now I know that was stupid. No, I knew it was stupid when I was doing it. That's how much power biases can have in your head, like overconfidence. In this case, overconfidence in General Electric and the management of General Electric. So that I think is a very, I modestly will say, a very important contribution. You can read till you're blue in the face from people who are in the financial business, but they'll very rarely ever say what they actually personally experienced. And I describe it.
Yeah, for sure. I mean, there's so much we can learn from our mistakes and from other people's mistakes, and hopefully that can only like make us get better. And also the stories are great too, Bob. You're a great storyteller. Lots of fun little bits in there too.
Yeah, one of my most favorite parts was meeting Barry Manilow. It was 15 minutes, and I'm not a Barry Manilow fan. I don't think much of him. You know, I'm a Led Zeppelin fan, but I found the guy really interesting, and I was surprised at how thoughtful the man was. And you know, it's funny. Normally, you talk to people, you know, and it's nice. They don't leave a lot of impression on you, but he impressed me. I wrote a little chapter about it.
Yeah, well, I definitely encourage all of our audience to go out and read the book and leave us a comment if you did read it and what you liked, because I would love to read those. And I'm sure Bob would too. So thanks, Bob, again.
Thanks, Katie.
Yeah, thanks to everyone for sending in your questions. And we'll see you again in a couple of weeks.
Have a good one, guys.
Thanks.